All right, next question. Do I need a deed on a gap fund? Boy, you guys are asking a lot of questions. We will get to all the questions after, but we will. We're going to have so many questions today. It's going to be so much fun. All right, do I need a deed on a gap fund? So that's not really a tax question, but I'm going to answer it anyway just because a lot of you guys are doing this. So gap funding, that's essentially a loan. Some of you guys call it a joint venture. However you structure it, it's I'm putting in money and I'm expecting to get interest back out of it. That is a loan. That is a note. And whenever you have a note, then there's how do I make sure I get paid back? And that's called security. So if I don't want to get paid back, don't have security. If you do want to get paid back, make sure you have a secured interest against the asset. So this is like in a house, you have a mortgage, right? When somebody loans you money, there's two pieces here. There's the loan itself, and then there's actually the security against the piece of real estate. They're not like mutually, like they're not tied together. Like, hey, if you don't pay the note, and you sell the house and there's not enough money there from the house to pay off the note, they can still come after you for the difference unless it's called non-recourse, which case what they're saying is we can only go after the asset. So if you do a gap fund and you're loaning somebody money, I wouldn't do that. I would make sure I have a deed against the property, and I would probably make sure that it's recourse so that I can go after them in case they screw it up and lose me money. Like, hey, we sell the house and it's still not enough to pay me back. See, a lot of gap funders get hosed that way. That's a legal term for you lost your money. So it doesn't matter what we're looking at. If it's a car or anything, you have the loan, which is one document, and then you have the secured interest, a UCC1, when it's cars and things like that, or inventory or stuff. You know, it's can I secure the interest? So if you are a gap funder, and you're loaning money to somebody and you want to make sure you get paid back, the only way you're going to make sure is if you file a deed of trust or a mortgage against that piece of property, so that if that property is sold, you get paid back. The escrow company will pay you back to extinguish your lien before issuing any money out to anybody else. Otherwise, expect them to sell the property, keep the money, and then run around and make you chase them to try to get paid back, which you want to make sure you're not an unsecured creditor. In the bankruptcy setting, those are the people that don't get paid.